Can you use IRAs and Roth IRAs to pay for qualifying college expenses? Yes, you can, but I wouldn't normally recommend it. Hi, I'm Matt with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, be sure to subscribe to our channel and ring that bell to be notified when we post new videos. Now, why would you use an IRA or Roth IRA to pay for college expenses? Well, typically it would be because you don't really have any other good options. And you could avoid the normal 10% penalty on withdrawals before age 59 and a half. But don't confuse that with avoiding income taxes. These withdrawals will not avoid normal income taxes. So any amount you withdraw from a traditional IRA would be fully taxable, and any growth in a Roth IRA that has not met the 5-year rule requirement would also be taxed. Using an IRA or Roth IRA for college expenses is really an advanced planning strategy, but it comes at a cost to your retirement savings. And as I said, not usually a great idea. So what type of person might this be appropriate for? First, you want to have a good understanding and knowledge of the tax rules. Second, you need to understand that you would be using money normally intended to provide for you in retirement. So you want to make sure you have sufficient retirement savings elsewhere. Of course, you'll also need to be eligible to contribute to and have money in your IRA. So let's take a look at some advantages and disadvantages in using this strategy. The obvious advantage is avoiding the 10% penalty on withdrawals before age 59 and a half. But maybe the biggest advantage is that retirement assets are not used in most financial aid calculations. If the same amount of money is saved in a, for example, Coverdell ESA or 529 savings plan, a portion of its value will count when determining financial aid eligibility each year. So another advantage is that any unused funds in an IRA, if held until normal retirement age, or at least age 59 and a half, would no longer be subject to that 10% early withdrawal penalty. And in the case of a Roth IRA, that means the 5-year rule won't be subject to income tax either. Other savings plans meant specifically for college often come with restrictions that keep you from using the money for anything else without penalty. For example, there's a 10% penalty plus income taxes on unused Section 529 plans or Coverdell ESA funds when they are withdrawn for any other purpose. If you have other questions that we didn't answer in this video concerning this strategy, post a comment below. We'll do our best to answer those questions in other videos. And we've covered some of the potential advantages to this approach, but in this case, we want to be sure to highlight the several disadvantages to this strategy. As I mentioned, it's not a strategy that we ever recommend, and I'll share with you some of the reasons why. Maybe the biggest is simply the loss of the use of that IRA money for your retirement savings. College educations can be very expensive, but not likely as expensive as many years or decades in retirement. Since you're only allowed to contribute so much to an IRA in a given year, attempting to replenish the funds you used in a timely manner, if at all, could be impossible. Not to mention the fact that you lose the advantage of tax-deferred growth on any funds you remove. Another disadvantage we mentioned already is that funds that are withdrawn from a traditional IRA will be subject to state and federal income taxes. In a Roth IRA, if you're under 59 and a half, any funds over and above your original contributions that have not satisfied the 5-year rule will be taxed in the same way. So when you compare that to the fact that tax-free withdrawals are permitted for Section 529 plans and the Coverdell ESAs, you could be wasting a lot of money. As an example, if you withdraw $20,000 for qualified college expenses from a traditional IRA and you're in a 25% tax bracket, while you do avoid the 10% penalty, it would still cost you $5,000 in income taxes. If you withdraw enough in a year, you could even place yourself into a higher tax bracket, with any taxable amounts coming from your IRA counting as additional income. Now, the same withdrawal for educational expenses from the 529 or Coverdell ESA accounts would be tax-free. So what are the eligible expenses and rules? Qualified higher education expenses can include 1, tuition at the college level or higher, but not room and board. 2, books, equipment, and fees if they are required by the school. For example, if a student feels they need a computer, but it's not required by the school, it will not count as a qualified expense. Some rules to be aware of are, number 1, to avoid the 10% penalty, the funds must be used for the education of the account owner, their spouse, their children, or their grandchildren. The expense must occur in the same year as the IRA withdrawal, and the withdrawal cannot exceed the qualified amount. And 3, as a reminder, these penalty exceptions only apply for IRAs and not other qualified plans like a 401k. The bottom line, it is a strategy that can be used, but it must be done the right way, and is probably not advisable from most people. If it is something you're considering but would like help, you can apply to become a client by clicking the link below in the description. Thanks for spending some time with us today. If you found the information helpful, please give us a thumbs up, share it with a friend, and don't forget to subscribe and to ring that bell to be notified when we do post new videos. And as always, live today, plan for tomorrow.